hope that whoever listens to this wants to join us, either as an investor, a deal finder, an advisor, a fellow, or even just an engaged community member we can activate to help our portfolio companies be successful.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of Alternative Investor Mastermind. Really excited about today's show. We have a guest, David Beazley, and I've met David through the Kellogg Business School Network and got to know him over the last number of years. I'm actually also an investor in one of his funds. So without further ado, let me introduce David Beazley, who's managing partner at Alumni Ventures. And for those of you that are not familiar with Alumni Ventures, they're the nation's most active venture capital firm and the world's largest VC for accredited investors. What David will be sharing with us today is not only his background and experience, but how he broke into venture capital and the successful funds he operates, and how Alumni Ventures is attracting registered investment advisors, family offices, and other institutional investors to their funds, which is what David calls AV version 2.0. So with that said, David Beazley, welcome to the show.
Hi, Jack. Thanks for having me.
Thank you so much for being here. I know you're super busy. You've got a lot going on with this growing portfolio and this new initiative you're launching. So thanks for spending the time.
I am for sure, but sincerely appreciate you taking the time as well, because I know you're a busy guy also.
Great. Well, let's dive in here. Just starting off, it'd be great for you to just tell your story. Just talk us through your early career and how you how you kind of got into Northwestern and how you kind of moved into what you're doing now.
Yeah, I'm actually a two-time Wildcat, both journalism degrees, and caught the entrepreneurial bug coming out of Medill's magazine publishing master's program. From there, I built a financial newsletter targeting high net worth investors and financial services professionals, teaching and advising them how to invest in alternative investment strategies, including venture capital, of course. I ran that business for almost 2 years and successfully exited. That was my foray into the world of finance and entrepreneurship. But obviously, Jack, my heart navigated to the dark side. I love the finance side of the business. After my startup, I spent a couple years managing money professionally as a registered rep, wielding my Series 7 and Series 66 licenses, then created my own firm in 2002. We launched as an independent sponsor, but quickly evolved into boutique merchant bank with two primary practice areas, private placements and venture capital. But by the end of 2016, the only thing I was having any fun doing was investing in venture stage businesses and trying to leverage my own social capital and intellectual capital to advance the initiatives of those companies we invested in to effectuate positive outcomes for me and all the syndicate investors who followed alongside of me.
Great. And I've enjoyed talking to you about that in the past, because some of your past is what I'm more focused on now. And I know you had some real estate syndication in the past as well, but that's for another episode. So what specifically drew you to Alumni Ventures?
Opportunistically, for both of us, I think it was at the end of 2016 when this scrappy startup just outside of Boston came calling on me, touting this franchising model for alumni venture investing. I was extremely skeptical at first, especially since I was managing a lot more money than they were. So I had my analyst at the time look back at 25 years of venture deals, focused on the top 500 deals being done each annual cycle. And what he found quickly convinced me that this wasn't a good idea. It was a great one. Methodology is important here, Jack, so excuse me for getting into the weeds for just a moment. We looked at the top 100 firms, including Benchmark, Sequoia, NEA, Kleiner, Andreessen, Google, Bedrock, Bessemer, Excel, Lightspeed, True Ventures. and specifically at deals that more than one of these top firms invested in. Through that overlap, a pattern emerged. 98.5% of the time, let me repeat that number since it is statistically significant, 98.5% of the time, we found a founder, executive, board member, angel investor, or the lead partner in the venture firm leading the round of financing attended one of our alumni ventures schools. Pretty remarkable. That's when I knew Alumni Ventures wasn't a good idea. It was a great idea. And I jumped in with both feet. Fast forward to today, Alumni Ventures now has $1.3 billion under management from 10,000 accredited investors. And as you mentioned in your introduction, we are now the most active VC in the country, investing in 300 plus companies every single year.
That's a pretty amazing story. And how have your funds specifically performed during this time?
Well, we're now raising our 8th fund for Purple Arch and our 4th fund for Lakeshore Ventures. We are currently the largest fund at Alumni Ventures and have the most cumulative assets under management, and that would include syndication dollars, which are individual deals our LPs get to invest in alongside of our funds. But to answer your actual question, I think a lot of that capital chasing us is due to performance. Collectively, the funds that I've managed since inception have more than doubled the S&P 500. But that is the worst possible statistic to measure how well we've actually performed, since the majority of our gains have come from our first 2 funds, which have actually had some time to mature. But the majority of our capital has been raised in our last few funds, which are really early in their investment cycle, diluting those returns a little bit.
Yeah, that's completely completely understandable. So I think most people, at least those listening to this podcast, would have guessed that Stanford or Harvard, MIT, Caltech would be doing the best. Why do you think you're winning?
It actually starts and ends with my team, Jack. I've surrounded myself with hardworking, competitive, driven, intellectually savvy, but incredibly humble humans and colleagues. Everyone on my team has grit, integrity, ambition, and an element of scrappiness, something I call a collective effervescence. And as I view venture investing as a team sport, I can't think of a single firm in venture more poised for success than us. All of us have been operators. All of us have empathy for founders, and all of us have a willingness to outwork everyone. If I'm ever asked, which I often am, what sets us apart? What's our secret? I simply say we know enough to know that we're not smarter than the other teams or other firms, but what we can control is how hard we work. If other teams see 500 new deals a year, we're going to see 1,000. Seeing more deals refines our pattern recognition, and over time we will win. And that is a small example of the incremental improvements made every day, leading to outcomes that we can claim and be proud of. No one on our team is clocking in 40 hours here, except for maybe me when I'm on vacation. But we live and breathe venture capital, I guess is the point that I'm trying to make there. On top of that, our friends, colleagues, and classmates like you are investors in this fund. We owe it to them and all of our stakeholders to do everything we possibly can to ensure the success of our investments. That's why we're winning. And that ethos is what investors will inherit as they come into our new venture wealth funds.
That's great. I'm going to just share a little bit of my perspective as an investor as well. I've been fascinated with venture capital, but I'm really a real estate guy by trade. And I've done 1 or 2 little deals where I might throw 25 grand in with like a classmate or 2, but I don't feel like I have enough money or enough expertise to do venture capital at scale. So I look to your firm knowing that there's, you make most of your money on the few big unicorns that 1,000x, and I didn't feel I had enough money to have my own diversification. So that's why I've looked towards venture capital funds for all the access and everything else you provide and your expertise. Granted, if I have a friend and I want to throw a lottery ticket into one of their deals, I do that occasionally, but a bulk of my venture exposure, 90% of it is through your firm. And just, we talk, we're not giving official financial advice, but our audience, I preach this all the time for real estate as well, to have the diversification across operating partner sponsors and have someone who has enough scale. So congratulations on that. So you've mentioned the new initiative a few times. This might be a perfect time to segue and tell us a little more about your new initiative for Alumni Ventures 2.0.
Yeah, thanks, Jack. With 40 investment professionals in the field, like us, all seeking those same types of fund making power law opportunities that you alluded to, we're all investing from the same playbook. We have, through that conglomerate, created unparalleled access to top tier opportunities. With our consistent quality and high volume, coupled with a massive maturing portfolio, we can literally build a fund for nearly anything. But what and actually I might be getting ahead of myself here, but going back to our first principles as a firm, one of our North Stars is to democratize access to venture as an asset class. Up until now, venture has only been available to the super rich and institutions, as you already know.
Yeah, absolutely. And I talk a lot about this. It's really only since 2012 when they changed the rules could you even advertise without risk of being slapped by the SEC. These were really country club deals. You really had to be in this old boys club to get in, which is absolutely a shame. That's both for access to real estate, access to private equity and VC. So I guess on the VC side, that meant that companies staying private longer, and really all of that upside was being gobbled up by the insiders and by kind of that old boys club I mentioned.
That's exactly right, Jack. I couldn't have said it better. We've also been a little elitist with our own funds, to be honest, only allowing folks with connections to our illustrious alma maters to invest with us. But as of today, you don't need a degree from one of our, universities, one of our schools hanging on your wall to invest in our funds. We now have wealth funds, which mirror the venture investments made in all of our alumni funds.
That is awesome, and kudos to Kellogg being known as more of the marketing school of the MBAs. It's good for getting that, allowing that broader base of investors into things. So, your entire model is unique in attracting individual investors, and you've got, did you say 10,000 of them?
Yes.
That's incredible. I mean, we're barely, I think, at 100 for our series of funds, although you've been at it a little longer than us. What do you think has caused them to join you? What do you think the secret sauce is to get to 10,000?
Yeah, I'm flattered that you would even ask. I feel like I'm just a cog in a giant flywheel, a virtuous circle of value, if you will. But I want to make it clear that any accredited investor listening today can invest in our venture wealth fund with approachable minimums. So that's definitely one of the reasons, right? 25,000 is our minimum investment. Every deal we do as a team will get allocation from this fund, a clone fund, if you will, or a mirror fund. And I think that's become really attractive for someone who's trying to diversify their overall portfolio.
That's great. And speaking to the audience that's maybe not as familiar, wasn't in one of the business schools, what would you say your differentiator is, as a firm, or even in the venture opportunity, as a whole, compared to maybe other index funds or just the other parts of the investment industry?
Yeah, again, aside from the affordability, right? You don't need 5 million or 25 million, which is the minimum to get into a Sequoia fund. or the fact that everyday accredited investors can get into our funds and sort of earn that professional grade portfolio, I would say two things give us a competitive advantage. One, the collaboration amongst funds. Collectively, we're seeing a ton of deals, 1,000 per month as an entire firm, and the deals being done by, one of our other teams, we can hand raise to secure an allocation. And that's a two-way street. They can invest in our deals as well. This really gives us global coverage and the ability to cherry pick the best of what we see for the benefit of our investors. Two, our ability to leverage our community of 650,000 alums who all want to be activated to help our portfolio companies be successful. Think revenue producing customer introductions, filling in HR gaps as companies scale. That is how we help our portfolio companies win, and also how we win allocation into oversubscribed rounds.
That's great stuff. Let me just back up a minute here and just ask a more fundamental question. Is there a core specific investment thesis for Purple Arch or Lakeshore Alumni Ventures, or even just a personal thesis or personal deals you tend to lean into?
There is. Our focus and our thesis revolves generally around investing in the future economy. We're deliberately diversified across stage, industry, geography, and lead investor. But that might be too broad for your audience. So let me be more specific without giving away any of our trade secrets. In general, we like companies solving hard problems. If they're successful, they can build value for all of the stakeholders, including investors, if we're lucky enough to get into those opportunities. We also like category creators, defining a net new problem and creating a net new solution. With existing categories, the economics have already been established. And even if you build a better solution, the price has already been set. With a new category, those economics haven't been established. Setting the price point becomes the driver. Don't get me wrong, though, Jack. I, like everyone in the venture realm, like disruption too, especially if there's non-consensus, meaning the price hasn't been bid up yet. If everyone agrees it's a good idea, valuations get inflated, and there's probably already a competitor in the space capturing market share. The trick is actually to find those deals before that all happens. Airbnb is a great example. Most thought no one would let strangers stay in their homes, no matter what they were willing to pay. But VRBO, HomeAway, and Airbnb proved the naysayers wrong. And they were really the quintessential example of the sharing economy, which brings up another great point about deals I like. Bill Gross, the legendary founder of the startup studio, Idea Lab in California, did an extensive study and determined that timing was the number one determinant of a startup's success. Don't be too early, don't be too late. Launch in that Goldilocks zone and hit the market when it's ready to receive your value proposition. For Uber, Lyft, Airbnb, and others, they launched when the economy was struggling in that 2008, 2009, 2010 realm. Sharing your excess and turning it into spendable dollars seemed like a great idea at the time. We will see those opportunities like this emerging from these economic conditions as well. Personally, I also have an affinity for marketplaces. I was an early investor and operator in a marketplace business and learned a lot of valuable lessons from that experience. One of them was, to build a successful marketplace, especially a two-sided one, at least one side of that equation needs demand that is beating a path to your door. Creating demand and selling both sides becomes difficult and incredibly expensive. But if you get it right, I love the business model of aggregating buyers and sellers, especially in old, antiquated businesses like chemicals, durable medical equipment, and heavy machinery replacement parts, but also in really new asset classes like cryptocurrencies. And despite current market conditions, Coinbase is still probably the best recent example of how a marketplace can work successfully. And finally, I like entrepreneurial teams that have customer acquisition as part of their core DNA. I believe that companies that have an unfair advantage in acquiring and retaining customers will produce outsized returns. It is that maniacal focus and deep appreciation for process and exceptional talent that makes them stand out for me. And Jack, sorry, that was a little long-winded, but let me come back to you.
Yeah, no, that was really great stuff there. And as you were talking about being early or late, I've heard this quote a bunch recently, like being early is just as good as being wrong. I know that from a couple of crypto startup guys that I know from Puerto Rico that we're in on the earlier cycles with ideas maybe that are coming to fruition now, but just weren't ready for. We're just too early for prime time. I want to go back to something else you said earlier. I think you mentioned there's a collective 600,000 alumni in the network. Can you just tell me a little bit more? Maybe just give some examples of like how you're leveraging that alumni network and how it's allowed you to do so well.
Yeah, happy to, Jack, and apologize in advance if this sounds like a complete commercial for Alumni Ventures. Obviously, I'm very proud to be a part of this organization, but you asked, and I'll tell you from my perspective. By leveraging tight community connections from alumni at top universities, we access great deals, which helps us assemble diversified portfolios investing in 25 to 30 early growth and late stage companies per fund or per team. In less than 8 years, since I've joined, we are in a position to raise and deploy hundreds of millions per year with the infrastructure and capacity to do $1 billion per year without adding another single full-time employee. And Jack, you're now close enough to this organization to know that's really just the beginning for us. I feel like we're still fueling our rocket ship on the platform. And with our new registered investment advisor and fee-based advisor initiatives and the development of our products for larger formal institutions like pensions, endowments, and tribal nations, our deal engine derived from our network is the key to our growth. With the ability to put more money into the same number of deals, the rest is just packaging.
Yeah, that's amazing. And I don't know if it's the same in the venture industry, but I know in our industry, the more money you control, often the better deal terms you can get. So hopefully that continues to come to fruition for your company as well. Wow, we've went pretty fast and covered a lot here. Lot to unpack. Is there anything you want to dive into a bit more that you think would be helpful for the audience?
Going back to the stats, I think we've already talked about our assets under management approaching 1.3 billion, the number of new deals we invest in per year, 300 plus, but we haven't said the number of deals maturing in our current Alumni Ventures portfolio. That number is 1,300 and growing every single day. With 1,300 deals maturing and 300 new deals per year, we can build a fund for nearly anything. Think women's fund, underrepresented founders fund, an ESG fund, energy transition, deep tech, AI, mobility, or more broadly, late stage growth. Again, think unprecedented access. Pick a sector, stage, geography, or thesis area. No other venture firm in the United States sees more deals or makes more investments than us. You get the power of our unparalleled network and a turnkey solution for exposure to professional grade portfolios.
Well, I think that's really, really, really well said. Let's shift gears a little bit. Let's talk about the entrepreneur side here. It's I've seen the last couple of years. It seems like potentially it's been a little harder to raise money than it was maybe pre-COVID or during the first year after COVID boom. Are entrepreneurs seeing a lot of? Am I right about this? Or are they seeing a lot of fundraising option? And what's your pitch to an actual founder or company on why why they should seek VC funding or work with one of your funds?
So, Jack, to be clear on our model, we don't lead deals, set market terms, or take board seats. Alumni Ventures operates exclusively as a co-investor. So I will address your question from two angles. The value we create at Alumni Ventures and the value a lead VC should create beyond their check size. And actually, let's start there. So Andreessen Horowitz, A16Z is probably the premier VC on the planet right now. They have roughly 500 employees, and only 20% of them are there to find new deals. The other 400 are there to help those companies be successful. Every VC needs to adopt this model of capital second, value add first. Capital is always fungible. Second, lead investors almost always take a board seat. Founders need to see their board as their second leadership team and inspire them to remain a working board versus a reporting board or a lame duck board that does nothing. As a working board, accountability matters, and the best boards can back out the lens and see the forest through the trees. Most founders are too close to their businesses and focus mostly on the day-to-day critical management tasks. The board isn't. The board can drive intellectually honest discussions and debate. The board can also assist the founder in moving from a culture of accountability to a performance culture. But that actually might be a broader topic for another day, Jack. So we can maybe book another one of these to talk specifically about that. And as for co-investors and strategics like us, we earn our allocation by punching above our weight on activities that matter. In other words, founders should empower their VC partners to pay them to become a business development and recruiting arm for their business. Not sure other creative forms of finance can accelerate positive outcomes in the same way and bring the value that we do.
Gotcha. That's great. And that value add, when I first met you, I thought of the business as somewhat similar to how I thought of the real estate business. We're not a direct operator. In a majority of cases, we seek to co-invest and not seek control, but also add value anywhere we can, whether it's fundraising or even financing or just any connection we could bring. So I think that's just business 101 right there. So kudos for that. So I mentioned the theme of that it's been harder, funding's been harder to secure. Do you agree? What's the state of the VC funding market in 2024?
Definitely moving slower. In the later rounds, for sure. You have hedge funds like Coatue and Tiger Global pulling back on VC and PE in general, because they can find incredible opportunities in the public markets, which are far more liquid than venture capital stage deals. You also see corporate VCs pulling back as well, since this was a nice to have versus a need to have for their businesses. And when profits shrink, it becomes harder to invest from your balance sheet. But we're still seeing robust investing in the early stages. But even those rounds and valuations are being squeezed down, which is ultimately good for us. Buying low and hopefully selling high in the future, or to quote the Oracle of Omaha, Warren Buffett, be greedy when others are fearful and fearful when others are greedy. Wise words for sure. And we are heeding them as we in Alumni Ventures are staying in market with our dollars. We are just being a lot more discerning. If we don't absolutely love the deal and the valuation, we are passing. So we get to be value investors with VC upside potential for the foreseeable future.
I've got a quick aside here, just curious, and I don't know if it's applicable or not, but just on interest rates. I mean, when VC is either 100x or zero, do you think the interest rates have had any effect on on this?
When it comes to exits, absolutely, you're not getting the leverage buyouts, which is a key exit from a financial perspective. But you're still seeing exits happening from strategic buyers and the publicly traded incumbents they're seeking to disrupt. But without low cost leverage, the financial buyers have been sitting on their hands.
Gotcha. Great. Appreciate that clarification. As a real estate guy, and a lot of people in real estate here, I think that's, the interest rates have dominated the news, and they're on our minds every day. You've mentioned a lot about the kind of the value add and the operator expertise to increase the likelihood that investments provide return on investment. What do you think of the need for operators in VC, and do you think there'll be more operator-created VC firms in the future?
I actually think there's several attributes that make a great VC, Jack. I think being a former operator is just one of them. Alumni Ventures have a number of former operators at the firm, including myself, and that certainly helps connect with founders, most of whom are open to coaching, and who better to coach young founders than former operators. Former operators are also really empathetic to the difficult and critical decisions being made every day by our founders. This empathy is crucial to building a trusting relationship with them. In addition to being a former operator, though, I think there are other necessary qualities, needed to be a great VC. I think having an easy but diligent underwriting process helps. No founder wants to be scrutinized incessantly. They want to complete their fundraise and move on to the business of running their company. And Alumni Ventures, in general, certainly thrives on that easy process. The few other things that make a great VC are, in my perspective, supportive market conditions, thoughtful portfolio planning, a defined thesis, and not accepting the status quo, which is a direct reflection of us, since we are disrupting a business that invests in disruption. But for me personally, Jack, in my own growth to becoming a great VC, I try to be a student of industries and markets, and try to recognize things that are moving in and out of favor. What our limited partners or investors should look for in our team is strong investment experience, startup operating experience, as you mentioned, as well as a compelling investment strategy and a certain amount of diversification. Investors and founders get all of that with Alumni Ventures.
It's very, very, very well said. Is there anything else that you just like to share about your career, point of view, or Alumni Ventures?
Yes. At this point for me, Jack, it's about impact. And let me clarify that and give it some context. After being a part of a successful investment exit back in 2015, it was time for me to start giving back to the alma mater that gave me so much. At that point, a few years ago, I joined the Newvention Advisory Board to help Northwestern University advance its entrepreneurial experiential learning curriculum. I also began helping Kellogg in the Garage, which is our on-campus student startup incubator, mentoring students and judging pitch competitions, teaching students about venture capital, making sure I touched campus at least once per month. But it still wasn't enough for me. Then in 2016, I went to a few of our trustees and tried to resurrect the Wildcat Angels. I had a vision for a fund and a dedicated angel group that would invest in alum-led companies, but I couldn't gain any traction with the university despite what I knew and conveyed to them about pent-up demand. So I tabled my ambition until the opportunity with Alumni Ventures landed in my lap. As I investigated Alumni Ventures and its model, it seemed like the perfect platform for me to advance my personal initiatives and my desire to give back. So I coined the phrase "with purpose but for profit" for our fund. I think that what we're doing at Alumni Ventures can have an immense impact on all of the stakeholders, including the universities as a whole. I think what we're seeing is that successful entrepreneurs are becoming the new rock stars. They're certainly influential in business, but also culture. So as we continue to invest in alum-led companies and highlight their successes, I hope we become a beacon, not just for more investment dollars in us, but for more donations to the schools as a whole. The same way donations increase when a basketball team plays in the tournament or a football team goes to a bowl game, our entrepreneurs are actually a more relevant reflection of the greatness of our universities. And in my experience, the pride and affinity I feel when I read about alums changing the world one company at a time is a mission I want to be a part of for as long as I can. In the case of Alumni Ventures, our capital can be that catalyst, taking a small part in helping create a successful entrepreneurial ecosystem, boosts the status of all of us who attended, and hopefully inspires future alums who have that same affinity and want to give back and pay it forward. That is the mission of Alumni Ventures and my team specifically. We want to deploy billions over the next 10 years into thousands of alum-led startups. And I hope that whoever listens to this wants to join us, either as an investor, a deal finder, an advisor, a fellow, or even just an engaged community member we can activate to help our portfolio companies be successful.
That's great stuff, and I thank you for your support of the kind of the Kellogg incubators. I actually through one of my classmates, I'm invested in a company called GearFlow that won one of the Kellogg startup competitions a few years ago, and I'm enjoying following along in their journey. And actually, another company through another classmate called Cherish Health that's somewhat like I'm going to do a terrible job of describing it, but they essentially have the 5-second pitch was think Amazon Alexa for your grandmother that could detect if she falls down or doesn't get out of bed and can see through walls through the LiDAR. So two really cool things that I'm just, doing just because of my Kellogg experience and just supporting and liking the ideas of classmates that were directly involved. And obviously you're doing it on, 1,000 times bigger. And other than these personal relationships that I just kind of, do for fun and to support my friends, like I could never do it as a full-time investor myself. So, but that was a little bit of a digression there, but thank you for your support.
Yeah, of course, Jack.
So a couple more questions before we finish up here. First is if you can give a younger person career advice on how to break into VC, what would it be?
Very quickly, because I know we're running out of time, and I've certainly been talking quite a bit. Take every meeting, build your network. 2, join our venture fellow or venture analyst program, which has great practical experience. 3, work in a startup at some point. 4, become an angel investor and advisor. You can do it with only a few $1,000s and your time. 5, get smart on new things, meaning, consume books, blogs, podcasts. Make it your mission to gain practical knowledge every single day. 6, become a scout for a VC firm. 7, a little self-serving here, read my white paper, Redefining VC, which is kind of a VC 101 in a 2-part series. 8, become an expert in something. Have a domain passion, but be flexible enough to join firms as an expert generalist.
All right, so we've talked almost all business here. Second question, what do you like to do for fun or in your spare time?
Like everyone else, I love to travel and see new places. I love to read, and I'm a lifelong learner. What I actually love to do in my spare time is write. I'm an aspiring novelist. I have 4 books at various levels of completion, and 1 sort of autobiographical, motivational self-help book I'm working on in my free time. The working title is Front of the Plane, Back of the Car, Top of the Building, which is a reference to a speech one of my wealthiest and exceptionally brilliant former clients once gave me about measuring success. After 20 minutes of talking about material success, he laughed it all off and said, "Just kidding. Your legacy won't live on in material things. It will live on in friends, family, and colleagues who who you have touched positively and personally. It was I should say, was a great motivator for me. But knowing how to think and approach things isn't enough. You have to put those thoughts and frameworks to action. And that is actually what the book is about, the application of positive thinking.
That's great stuff. I need to pick your brain at another point because I've really thought about, writing a book on my real estate path, which, has had its ups and downs and twists and turns and, but write it in a way that's like an autobiography, but also helpful. I sort of like Tim Ferriss 4-Hour Work Week, but real estate and the good, the bad, the ugly. So that's another conversation as well. But I look forward to seeing it. And when it gets done, certainly come back on to promote the book itself.
Done.
So, okay, last question. Tell me about either a favorite quote or a favorite book that you've read.
Jack, I actually live by a mantra that came to me by way of my exposure to athletics. It was given to me by Steve Musso, a former coach, mentor, and motivational speaker. Here are his wise words. You move towards and become like that which you think about most. I wake up every day thinking about success, not only for myself and my fund, but for my partners at Alumni Ventures as a whole. His main point in those words were that if your actions do not follow your thoughts, you will drive yourself crazy. So I always ask myself, what can we do to advance the business today and every day? That could mean finding a deal, a dollar, or just a new and improved way to tactically execute a business process. If we wake up every day with those goals, we are destined for success. Jack, I just want to sincerely thank you again for having me. This was a lot of fun. And for everyone interested in learning more about Alumni Ventures and our mission to democratize access to venture capital, they should definitely go to our website at av.vc. And to reach me, they can connect on LinkedIn or email me directly at dbeazley@av.vc. Beazley is with a Z as in zebra. Thanks again, Jack.
Great. Thank you so much for being here. We'll make sure we put that in the show notes as well. I hope everyone enjoyed the episode. Please, if you're listening on YouTube, please like and subscribe. Smash that subscribe button. And Spotify, iTunes, all your podcast platforms, please like and subscribe. And we're also on all major social media, both my personal name, Jack Krupe, and JKM Investments. So, David, thanks again, and really look forward to staying in touch. And hopefully we can do another episode in the future. Great content.
Sounds good. Thanks, Jack.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.